Welcome everybody. We still have some people hopping in here. Um, okay, so we are now past some of the volatility. When I say volatility, I'm not just talking about market volatility. I'm talking about just the volatility, the uncertainty, the new programs being rolled out, the tariff discussions, and the tariffs changing, and so on, back and back and forth and back and forth. Um, Meanwhile, all of you guys have hung in there, and that's hard. Like this is what we said last time is this is what the work feels like. It's really easy to be an investor when everything is sunshine and rainbows. Very difficult to be an investor when there's terrain that you're not familiar with, and when the media is hyperbolizing and exaggerating things. It's really hard, which is why we want to make a community out of this. It's way easier when you're going through it with others, when you have a team. Now, since we've gotten through this, let's kind of reverse engineer what's happened. It wasn't too long ago, a few weeks ago, where it's all doom and gloom. Oh my gosh, this is going to break the world's ecosystem. The world's going to hell. You could imagine some of the phone calls that we had to take on and the conversations. And I feel bad because some people are literally saying, right, like I'm going to move. The amount of people say I'm going to move out of America. All my money's going to go away. All of these things. That's how interesting fear can get. And that's a normal part of this process. But here we are after another little mini cycle, and right, the world's okay. And if we let's just look at the market real quick. If we zoom out, and I have a real-time shot here of the S&P, and if we just zoom out to a year, right, the S&P is positive again. If we look at year to date, the S&P is positive again. Now, not saying that that's going to stay that way. That's part of this. Like short term, it's going to be choppy, especially when we have a president, right, who likes to make significant changes in short periods of time. Love him or hate him, right? It causes uncertainty, and then uncertainty causes volatility. So I'll pause real quick. Colin, I would love to get your take on, remember what the feelings, right, were like a few weeks ago and relative to what they are now. What do you think about that recent past, and what do you think about the upcoming future here?
I think, just it's true in life as well as in investing. Feelings are fleeting. And that makes it tough. That makes it very difficult. And it's not lost on us how like emotionally uncomfortable it can be at times. But it wasn't long ago where I was fielding phone calls that said like, "Hey, why do we have cash when the market's up 20%?" Right?
Mm.
There's feelings on the other side of the spectrum too. And just because things are positive or negative, right, doesn't always necessarily mathematically or financially validate that feeling. So we do have to be very careful when it comes to acting on those feelings. No one, or Wes or myself, we'd never ask you to not have the feeling. It's very human to have the feeling. But the way that you respond to the feeling, the way that you behave around the feeling, or the way that you make decisions because of those feelings it's why we're here, right? We are supposed to be the coach that we've seen a lot of it. We've dealt with a lot of it before, maybe not the exact flavor, but a very similar one. And it's a good reminder to remember what you're invested in. Nobody has a stock in Donald Trump, right? Nobody has stock in a Republican cabinet, right? What you own in our long-term equity ownership vehicles is business, right? And some of you may be real estate as well, right? So that's a very, very different and distinct investment than what most people I think look at it as like, a ticker symbol on the screen or a squiggly line that's either green or red, something of that nature. I think it's always important to remember what you're actually invested in. And at the core of it, it's value creation. So when Costco, benefits a marketplace, and then captures a portion of that value for Costco, you as an owner, right, get to reap the benefits of that value capture. So just a good reminder now that I think Wes, thank you for staging it that way, for setting it up that way. Of like we are past maybe this initial push of volatility in many aspects. It will come again, maybe not a tariff wave, but again, a different flavor. And it's good to remember, times like this. I would, I'd throw a question out to all of you on the call. When's the last time that you thought about or remember the feeling that you had during the COVID dip, right? Or during like Ebola, right? Back in the mid-teens, right? Like you had similar feelings that you experienced over the last maybe 3 to 6 months, but they're fleeting, right? Again, these feelings are very, very fleeting, and you probably had a very opposite, but almost like a mirror image feeling of, hey, my cash was sitting basically doing nothing for me last year when my equity account was up 20%. Why do we have this cash again, right? Well, this is a reminder, right? This volatility, the buffer between you and the volatility is the purpose for the cash, right? Not the 4% that you're getting on it.
Yep.
So I think those are some of my initial thoughts.
And when Dave was alive, he was obviously the senior member of the team, and he saw way more than I saw because he had been around longer. But thinking back on that, I was first licensed in 1984. So that's 41 years ago, which kind of means, so not only does it fall on me to be the senior member of the team now, but it means I'm getting older. And I've seen a heck of a lot of crap as time has gone on. It's like, think back to Black Monday. That was in 1987, guys?
Yeah.
All right.
I was around.
25% down in one day. One day.
Yeah.
A quarter of your money disappeared in one day. That's unbelievably scary, right? So to Colin's point, to Wes's point, it's going to happen again. We just don't know what that looks like and what flavor it's going to come in. But again, all of these are mini lessons that allow us to weather the storm going forward if we keep perspective.
Joel,
Yeah, I
that's
completely agree.
true. Hi, it's Trish. I
Hey,
wanted
Trish.
to jump in there. Hi, because I was there in 1987 and I was working in Los Angeles, and I remember the dip, and I've experienced quite a few myself. Your heart sinks to your stomach. And this is one of the reasons why I'm here at Attican Wealth Partners, because I experienced through a different financial firm that was handling my portfolio such a severe drop that I jumped from them to another one and then finally landed here. And I'm so grateful because I've seen my portfolio blossom with Wes and team and Shelly. They've done a fantastic job. But the feelings that are fleeting, there's also the reality markers. I work in cybersecurity, and I work with a lot of customers. I'm a solutions architect, and I work with a lot of customers in financial, healthcare, software markets, and they are experiencing a lot of emotions. There's been a lot of layoffs in my industry in tech, which creates a lot of fear, and people are watching this ebb and flow, and most significantly with the trade tariffs. That is also causing manufacturing halts across the board, not just in technology, but my hubby is in operational technology, or utilities, if you will, with them receiving holds on big orders, $1 million orders, multi-million-dollar orders across from China and from Europe, because everybody's putting things on hold. So I just wanted to add that. I'm not saying, oh, it's terrible. And yes, we'll go through ebbs and flows as we always do. The sun always shines and sets. But with a new day tomorrow, hopefully it does get better. But I love that Attican Wealth Partners has a very firm finger on the pulse of what's happening with the financial markets. So I just wanted to add that. Thank you.
No, thank you. Thank you very much. And, thank you for all the compliments. And we basically have three pillars here, right? Education, family, and community. The more we build a community to have open and honest conversations, honestly, the stronger it makes you as an investor. But then it also, and I kind of hate saying this out loud, it also helps prevent people from getting screwed over by like sales tactics and all these things. Like, there is no risk-free path. The role as all of us have here as leaders, we're either leading our companies or we're leading our families financially or we're leading ourselves. You have to make probabilistic decisions. There is no magic bullet. There is no shortcut. It's picking the most probabilistic path and then saying, I'm going to execute the fundamentals in a disciplined way over time, period. And if we zoom out a little bit and look at, sort of like the crisis of the day, was tariff conversations, et cetera. Let's just look at this chart that Colin found, which I thought was great. If we just zoom in, right, there is no lack of crisis events in the world ever, right? It's just, what's the next one going to be? And let's let it stop surprising us. There is going to be another COVID or a version of 2008 or a tech bubble or a tariff conversation or potential war, all of these things. And if we just look throughout, history, just in this chart alone, Korean War, JFK killed, Cuban Missile Crisis, Vietnam War, Nixon resigns, 18% mortgage rate, stagflation, Soviet Union collapse, Black Monday, and on and on and on and on. Yet there's still progress. And I don't think that's magic. I think it's because capitalism provides an incentive system to overcome and solve problems, all the way down to the individual level, where if Trish creates value by solving problems in society, that her and her family can get fairly compensated for that, right? So it's not about whether or not there's invaders. It's, are we out offensing those invaders? And the answer, in my opinion, in a capitalistic society is yes, because we have incentives to do so. It's not that it doesn't come with its problems. Problems are guaranteed, right? But we need enough smart people solving those problems. Colin, what's your take on the chart, bud?
Yeah, well, I love the chart. Like you have mentioned, there's always a reason to be fearful or, even potentially pessimistic. But it's important to remember that this is a relative game. So let's kind of like play through the scenario. It's like, okay, let's buy into the next tragedy. Okay, let's say that we think it's going to be horrible, so we sell our investment portfolio. Well, that doesn't mean you're not invested, right? And I think this is a very, very big deal that people a lot of times don't capture. If you decide to take your equity portfolio and liquidate it, right? You sell your mutual funds, your ETFs, your index funds, right? Your productive assets. It's going to settle to cash, which is just another asset that you're invested in, right? And over time, that cash is diminishing. We all understand that. We all agree. If you say, well, yeah, but I would reinvest it. Well, again, this is why it's so important to understand investing is a relative game. So if you're going to take it out of the productive asset portfolio that we've built and designed for your family, where are we going to put it? And if that doomsday scenario is true, right, and the war is on your home soil, right, or all of business closes or whatever, whatever the wild west scenario would be. Well, I'm not sure how the cash is helpful. Right. Matter of fact, it probably only puts a big target on your back. If it's still valuable in whatever that society looks like, the toughest guy on the block is just going to come take it. Right. So just because you get out of the quote unquote stock market doesn't mean you're not invested. You're absolutely invested, and you're just putting it into a currency, right, as opposed to productive businesses. So I just think it's really important to remember, like, we're not invested in tariffs. We're not invested in Donald Trump. We're not invested in Joe Biden, right? We're invested in business. And in this world, in this doomsday scenario where Costco and Microsoft and Home Depot and Apple Computer and Verizon Wireless and you name it, right? Hundreds and hundreds and hundreds, thousands of other companies are no longer valuable. I don't know what the solution is, right? And I don't think Attikin's going to be the one that would save you in that event. We'd need military, right, or something of that nature, right? So when our fear starts to go to the extreme, right, really play that out and understand what that means and understand the decision that you're then committing to. You are now choosing, instead of investing in valuable companies, you're going to invest in a currency. Right, so that is actually the fundamental decision that you're making, which, hey, maybe you'd be right, but like, not based on history, right? It would be a new landscape in which you were correct.
Yeah, absolutely. And if we think about this, if we start to focus on the progress, I think what happens is most investors get too far removed from what's actually happening. The reason that money grows over time sustainably is when there's an origin of value exchange and then progress being made on that. I wish I had some data to show you guys, but I've been researching a lot lately, like robotics, and how that's being used in the commercial space. If you look at Amazon, maybe next call I'll have some of the data. The amount of investment that Amazon has basically deployed over the last handful of years in robotics is off the charts. But you know what's even bigger than that is the amount of productivity increase that they've gotten from deploying robots inside of their factories now. And there's a bunch of really cool data. So if you guys don't mind, remind me next time to have some of that data ready for you. But if we look at something like Costco, I'll show you some graphs here because this is what your money's actually doing. Now, I am not, just real quick for our licenses, I'm not recommending that everybody go out and buy Costco. I'm using this as a business case study so you can actually understand how these businesses function. Because this narrative is not really illustrated when you just look at your phone and you see whether or not, to Colin's point, the ticker symbol is red or green for that day. So if we look at this real quick, let's actually see what a productive business looks like. So number one, here's Costco's number of locations from 2005 to 2024, right? All you have to notice here is the trend, right? So roughly, I think last I checked, it's like Costco is about 950 locations, something like that. Okay, well, that's location standpoint. Keep in mind, the more locations that they have, the only reason they would open up another location is if they were convinced that they're going to sell more things at that location. It is implied in the underlying action, right? Now, let's look at their revenue from 2005 to 2024. You go to roughly 50 billion to 260 billion in 2024, right? That's where I get the $30 million roughly per day of revenue, right? So they increase locations because they're increasing sales of services and goods, right? And therefore it increases their revenue. Okay, well, let's see what they're sharing with their investors. Here's their dividends chart. Costco's regular dividends per share from 2025 to 2024, right? Now, I could go on, but what do you notice about these three charts? They're following an upward trend. Now, that's not to say that all companies follow upward trends, clearly, but that is to say when we invest, you're investing in the largest, most expertise businesses and productive businesses in the world in history. It is hard to comprehend that level of magnitude. It's hard to comprehend $30 million. Sorry, it's not $30 million a day. It's $30 million an hour. I got that wrong. $30 million an hour, if my math is serving me correctly, like every single hour of the day. And I did that math based off a 24-hour day, not just a typical work day. That's insane. Now, if we zoom in even a little bit further, okay, let's look at productivity elsewhere. If you look at, we've talked about robotics and self-driving cars, right? One of the things that's a bummer for me in today's landscape is we keep on having conversations around a lot of macro things, tariffs, geopolitical concerns, geopolitical discourse, etc. But that's blinding us to a lot of the productivity that's currently happening, not in the future. It's happening right now, right? So if we look at something like Waymo, and these things are going to change the entire landscape of human productivity. Waymo, Google's self-driving autonomous car unit department, they started out at 0 rides. Most people don't know that right now, per week, they have, I think it's, what does that chart show? Over 250,000 paid weekly rides. Meaning that if you go to Arizona, currently right now, it's in Scottsdale, Arizona. If you go to Scottsdale, Arizona, you can get the Waymo app and you can hop in a completely driverless car, right? Think about how that's going to change the world. That means people like my grandmother, instead of her taking public transit, which I hate the fact that she takes, but I can't get her not to do it, right? That now a car can come and pick her up, right? And for those of you who think, oh, well, that it's going to be not so safe. Well, the data suggests otherwise, right? These cars are exponentially safer, the data suggests, than a typical driver. And the reason I'm saying all this is we are currently undergoing massive productivity shifts. And when you have massive productivity shifts for the better, that means your investments are going to be positively impacted on that over time. Colin, what's your take?
Yeah, well, so Wes, I mean, my wife's sister sent us a video of one of these Waymo cars that we're talking about, right? It was unbelievable, right? That she was sitting in the front seat of one of these cars, is driving her across town, and yeah, safe and sound, got there, right? So that's a real life application of it. But maybe this will just be kind of another stab at the same angle. Imagine 20 30, let's call it 25 30 years ago now, when most of you you're probably in the heart of your careers, what the internet did for the companies that you worked at, right? So if you can think of business back in the 80s, early 90s, prior to the adoption or the general adoption of the internet, of email, for example, right? AI is 10, 100, 1,000, I don't even know, like orders of magnitude more impressive, impactful, et cetera. And we are, probably not even in day one of it, right? So when we're talking about what the application of this is like actually happening inside of businesses, Amazon is a more efficient, better company today because of the adoption of technology, things like robotics, like we're discussing, because they're early adopters of it, right? Not because they're scared of it, or not because they're like, I don't know, I'm not sure about this. It would be similar to your company not wanting to adopt email 25, 30 years ago, right? And again, the AI has a lot more capabilities, a lot more functionality to it. So it's only exciting, right? But again, what sells in the media is that one of these robots is going to go rogue, right? And then, take your puppy or take your child or something like that, right? The adoption of technology has only been a net positive for humanity for all of history. I don't see that slowing down or stopping now. But again, it's not without risk. It's not without turbulence. It's not without some bad happening. But again, on a net basis, on a relative basis, right, you will be better off in the future, for your interest in or equity in companies, right? If not, we have a totally different set of problems on our hands, that is not market volatility.
If you think about probably one of the most common, I'll call it objections, for lack of better terminology, that we have with clients, is they don't give themselves enough credit for how long they're going to live. Right? It's like, oh yeah, but this is good for like younger investors. Like, wait, time out, time out, time out. We have to define short, medium, and long term in actual durations. Just because you're retired does not mean the game is over. In fact, it's almost like when the next game starts. If you are 60, 70 years old, just fun fact, life expectancy is increasing a quarter of a year every year if you remove smoking, drinking, and distracted driving. If you do that plus, right? So just keep that in mind, that this is why people are living longer, right? Because you're increasing the longevity span each and every year. That doesn't even factor in AI and the result that higher computing power has on pharmaceutical drugs. I mean, if we look at what are they called, GLP-1 drugs, like obesity drugs, love them or hate them, right? Because you guys probably know, like, my view on, hey, should you take a pill to lose weight, or should you get to the gym, et cetera. I know it's way more complex than that. That does not change the fact, right, that weight loss drugs are impacting society and very likely will in an enormous way. It is already happening. So what that is going to do for longevity and health span, in my opinion, I would not be surprised if we dramatically increase the lifespan of humans over the next 5, 10, 15 years. So don't be so sure. In fact, I was with a client yesterday. She is a unicorn. She is 80. She moves like she's 27 because she goes to bar class and Pilates class like 15 times a week. It's unbelievable. And she's like, well, I probably have another good 5 to 10 years. I was like, of what? And she's like, of life. I was like, first of all, you just talked about that very casually. But second of all, right, there is, unless you get hit by a car, I see very small chance you pass away in the next 5 years. She moves like an athlete. So I think we're going to keep on seeing this longevity span increase. So if you've just been doubling down on the mindset of like, oh, well, my game's over, so I'm just going to put all this into cash and bonds, basically having a guaranteed loss after inflation, what are you going to do when you run out of purchasing power? You might still have dollars in the bank, right? But if your expenses are now exponentially higher because of inflation, your dollars in the bank don't pay that off. That's a very bad day. You do not want to have to go back to the work when you're 97 years old. Colin, what's your perspective?
This is why I bring up my great aunt all of the time. My mother's aunt, zero life expectancy, longevity, I should say. I'm sorry, zero longevity on my mom's side, right? Both my mom's parents, that they did 79 and 80. All of my grandmother's siblings died, by 80-ish, except for my great aunt, lived to 102. Right? And you might say, well, she probably took really good care of her. Not at all, right? She worked in a rubber factory for 40 years. She was born on literal dirt floors in nowhere, West Virginia, right? Her mother died super early. She basically didn't know her mother, right? So that her longevity, right? Her father was a coal miner. All of her brothers died early. Sisters didn't have great life expectancy either. My great aunt, from the time I was 7, I'm 32 years old, right? From the time I was 7, my great aunt told me, hey, this will be the last Easter, this will be the last Christmas, this will be the last birthday, whatever it is. She proceeded to live a quarter of a century longer, right? So when I hear that objection, I immediately go to my great aunt, who never saw the inside of a gym, right, or a Pilates class or anything like that. Never concerned herself with what she ate, ever, not one time. Worked in a rubber factory on an assembly line for 40 years and grew up on dirt floors in West Virginia. There was like a mountain of evidence stacked against her, but here she was, 98 years old, living alone in her own home. That just has to be one of you, right? For this to be really, really important. So these general statistics aren't very, very helpful when it comes to things like this. When you talk about like a general pool of millions and millions of people, where they say on average you die at 77, well, what if you're the one person that doesn't, right? Or the hundreds of millions that don't, right? And live beyond it. So we have to plan for longevity. Longevity is without question the largest risk, without question, right? Because it's, you have more life to fund, but it's also a risk magnifier. It multiplies the risk of anything else potentially happening to you. The longer you live, the more likelihood it is that you're going to have to live through additional economic downturns, market downturns, etc. The longer you live, the more likelihood it is that you end up in long-term care, right? The longer you live, name it, more tax that you have to pay, etc. The cost of living rising, so on and so forth. Right? So we have to optimize for longevity. If we don't, we're ignoring literally the biggest risk. Right? So we have to keep that at the forefront of the planning process.
The other thing that is very common in these conversations is, well, I don't have the time to make it back up. That's very common, right? Like hey Wes, whatever, X years old, and I don't have, and they usually use an extreme example. Like, I'm not 25 years old anymore, so I don't have all that time. Oftentimes that time in their head is super inflated, number one, right? In their head, it's like, oh, well, it's going to take 20 years for this to make that. That is not true, right? Like, and it's our job. That's because I have failed teaching the actual data, right? But we just went through a mini little cycle. I want to zoom in on everybody, right, on this. The market in one day went up, what was it, 10%? Right? So our brains are saying, oh my gosh, it went down by X% and it's going to take 5 years for this thing to rebound. Not true. Like, you're entitled to your own opinion, but not your own facts. And I'm saying that to everybody, including myself. Our emotions want to give our opinions as facts, but we have to ground ourselves in reality. So if anybody ever has those thoughts in their head, that's my fault that they have that, because I haven't properly taught them, oh no, like, this is part of the game, right? It does rebound like that. Like, historically, it has. Are there going to be deeper recessions? Of course there will be, and there will be in the future. But again, you have to relate it on relative terms. If you do not invest for the long term and use vehicles that counterbalance inflation, you will lose money. So if you're not positioning it that way, it is a guaranteed loss because of inflation. But because it's just nuanced enough of like, yeah, but it's purchasing power, you'll still see the same dollar. So it gives this weird illusion that you're not losing money, but you are. Now, funny enough, I'm also not saying to never use short-term vehicles. As you guys know, we use short-term vehicles, medium-term vehicles, and long-term vehicles. And we are aware that when we use short-term vehicles, yes, we are signing up to lose money in the short term, but it provides the short-term stability. So we're willing to tolerate that loss after inflation a bit so that clients and families are protected in times like we just had this dip.
To give the other side of the coin here, I, I don't know about on this call, right? But certainly some of the people that will listen to the recording, it wasn't too long ago where we were asked, should we be investing in cryptocurrency, right? And the answer was true during the crazy up run, the same way it's true during the crazy turbulent down run, right? It was like, no, we stick to the fundamentals. We execute the blocking and tackling over time. Right. So if we jump asset class trying to chase a yield or trying to chase whatever's the hot pocket of the day, right? We are breaking fundamentals. I always think of a sports analogy. It's like, for whatever reason, for my entire life, I think of like basketball and football teams. There are certain things like running the football and blocking well and not getting penalties and playing good defense seems to translate well when it gets to crunch time, right? It's like just the fundamentals. It's not sexy, right? Not a lot of highlight reels come from just a clean form tackle, right? But it could be a play that otherwise saves the game. It just doesn't have that sex appeal like some things do, right? Cryptocurrency had that sex appeal, and it's very human to say like, what there's a shiny object out there. I want a part of that. I want to participate. But again, same thing. Right? It's not it's not like we think like crypto is like immoral or something like that, which maybe it is. That's for another day. But we want to execute the blocking and tackling. We want to eat the fruits and vegetables of finance. Either direction, right? When things are crazy, silly, good, or when it looks like the skies are dooming in gray, right? We want to stick with the fundamentals and execute it over the longest time horizon that we can.
Right. Now, if there's a counter argument, keep in mind, a lot of what has consumed the surface area of the media space has been macro conversations, right? What's going on at macro level? And I love Warren Buffett's quote on this. He basically said, well, if you've ever read the list of Forbes' richest 100 or 400 people, you've never seen an economist on that list, right? Economists who focus on macro stuff because it's all, which is very interesting. Now, that's also not to say that on one side of the fence, macro things you just can't control, right? It's going to consume way more of your time than it's worth, and it's not going to give you any practical, pragmatic steps forward. But on the other side, we can actually use some utility from it. So if we look at a macro topic like taxation, the guys and I have talked a lot, and our team has talked a lot about how can we bring in long-term tax planning into portfolios to benefit and enhance returns, enhance longevity of the portfolio, enhance security, et cetera. So let's walk through that real quick. The reason that we've been pushing on this so much is because if you think about it at a high level, let's just say we've got two examples. Well, let me zoom out a bit, and then Colin, let me know if you guys can see this. So what we focus on for families is holistic wealth building. Right? Building your worth, like your ceiling of your net worth, and also building a floor, and also trying to build your autonomy over time. Right? There are a whole bunch of investments out there that can do really well for you, but they'll just zap your autonomy. Right? Go and become a real estate investor and acquire 1,000 units, and you will find out what it's like to be wealthy and have zero time. Right? So if we zoom in on this, the whole landscape right now of, let's say, wealth planning, it lands between estate planners, right? And then you have CPAs, and then you have financial advisors. Estate planners focused on trust. CPAs focus on what? Just the last 12 months of taxable income and expenses, right? And then financial advisors focus on, stocks, bonds, et cetera. Well, that leaves this weird space in here, right? That if we combine these three, it can be a dramatically better picture for a family. Now, if you think about it like this, if we just zoom in on taxation, taxation is a macro topic. You cannot do anything about the tax brackets that you land in. However, you can control how much of your assets are taxable, right? With a longer duration plan. So if we look at this, well, what does that ultimately mean? Let's zoom in. Let's say we have portfolio 1 is a taxable portfolio. Portfolio 2 is tax-free. Well, let's actually zoom in on how that impacts your investments. If we have a $1,000 investment, right, and we make a 10% return, we have $100, right, of gross profit, and then we have a 30% tax, let's just say, okay, we've got $70 of net profit. Same exact investments, same exact value, same exact return in the tax-free bucket. Okay, we've got a $1,000 investment, we have a 10% return, all the same thing, $100 of gross profit, but here's the difference. No tax, let's say like in a Roth account, right? No tax, well, you keep the whole $100. Now, to the naked eye, it's like, oh, that's a 30% difference. Number one, that'd be big, yes, but it's actually bigger than that. Going from 70 to 100 is a 42.8% increase. Changing nothing other than the tax positioning of your investments. This is why when people say, "Oh, you cannot increase return without increasing risk," well, when you add a tax lens to it, that statement is completely not true. Have the same exact investment, same exact return, but you're removing the tax man from the net returns. Dramatically different positioning. Now, also, when you then add that, talking about right estate planning, then add that to your beneficiaries portfolio. And let's say now they're doing the same thing. So your kids are doing the same thing, you're doing the same thing, and now all of a sudden you're getting tax-free alignment down the connective tissue of the legacy plan.
Yeah, I'm glad the bookend to today's roundtable is taxes, since we started with tariffs. The Trump administration, they like, I don't know, delicately kind of trickled this out there, maybe a month or two ago, that there's two T's that they're going to focus on, and the first one was tariffs. And the headlines just kind of ran with that. And in fairness, that is what they focused on. But in the background, and something that I think we expect to be settled over the next, let's call it 2 or 3 months, is a brand new tax plan. Now, I don't have a ton of, insider information on it. However, all of the communication that they've given, all of the, the leaks or whatever you'd like to call it, they want to lower the tax burden on many Americans and on American companies, right? Which is probably the bigger deal when we're talking about like macro stuff, the markets. So I think, what I expect, and, maybe I'll have to eat crow, but what I expect that this second T, whatever tax cuts or whatever tax legislation that they ultimately go forward with, I think will be a much more welcomed, at least from the market's perspective, a much more welcomed discussion than what we saw with the tariffs, right? If that was like the turbulence, like, oh boy, what are we going to do here? I think if we see the lowering of corporate taxes, the lowering of the tax burden on many, many Americans, I think the response to that, not just at the individual level, but at the business level, will be an extremely optimistic and positive one. Right. So hopefully they staggered this on purpose. I don't know if I want to give them credit for this 4D chess, that I hear this narrative quite often. I have no idea. Maybe they were strategic about it, maybe not. But I think they rolled out what was going to be a bit more choppy first. Because the expectation is on the back end, we're going to follow up with news on new tax legislation that will be very promising, or at least the reception of it will be a welcoming one. So I'm looking forward to digging into that over the back half of this year once they finally set the changes or whatever amendments that they're going to make to the current tax code.
Yeah, and to wrap this up, I think, my final piece, and then we'll send it around the horn here. I would not be surprised if we're still heading into choppy waters from a headline perspective, from a macroeconomic perspective. So just everybody be prepared for that. That
Yep.
is part of the game. That is normal, especially when we have a leader who seems to me like really wants to make a legacy for like fast, immediate change. That is tough, right? So just because we've come back from where we were doesn't mean that it's still not going to be choppy. So everybody, if you ever want to call us and talk about it, and we'll talk you through it, and help secure your mindset around this. But like, just don't be surprised if it continues to be choppy for a little while. Joel, final words of wisdom, buddy.
Yeah, I think I would echo those sentiments. And the one thing I want to say is how much I'm so proud of everyone, not just on this call, but our entire client base, that yes, it was tough. Yes, it wasn't pretty to see. And yes, there were some, some difficult conversations, but everyone hung in there. Everyone did exactly what that we planned on doing. They stuck to the plan, and now we're reaping the benefits of that. And I'm also proud of our team that we were proactive in reaching out to people and making sure that we answered questions and calmed some fears. So I hope that doesn't stop. Our plan is to continue to do that. And it's only because we appreciate all of you and love all of you, and we want the best for you.
Onward and upward. Yeah, this is the game, right? This is exactly why we are on the field. So yeah, I would ditto all of the comments that both Wes and Joel made.
And final piece here, remember that when we talked about the studies that show, hey, investors can get 10% returns in perpetuity over long periods of time, but why does study after study after study show that they get fractions of that? 3%, 4%, et cetera, et cetera. It's because of going through those hard times, people bail. That's why. Like, it's not more complicated than that, right? The reason they don't get the returns that they could is because it's hard going at it alone, and it only takes one event to spook you. The amount of times where I talk to investors are like, yeah, I was doing really good, and then 2008 scared me, and I never got back in. It's like, that just destroyed your wealth. That one, you could have done great for 4 decades prior to that, and then you let one event spook you, and then you're out. And that just murdered your wealth. That one decision, that one time, right? And that's what we want to have here for you guys as a team to help you get through those times. There's going to be 20 of those times in your lifetime, and we want to help you to get through every single one of them. Because if you bail on one, you're done. Anyway, guys, thank you so much. It's an honor to serve you guys. If anybody needs us, give us a call, and have a great weekend. See you.